As everybody had been waiting, six interest rate hikes promised. The Federal Reserve finally stood par for the course and finally raised the benchmark interest rate to a range of 0.5% to 0.7%. A range, mind you, ladies and gentlemen, not necessarily any fixed point. During Janet Yellen's announcement this weekend, Friday, today is Sunday, 2 days ago, she said raising employment rates, among other measures, have led to, quote, considerable progress, unquote, for the economy. Adding that she and her FOMC colleagues expected the economy to, quote, continue to perform well, unquote. In response to the rate increase, gold prices began a steady decline, beginning around 1 o'clock, gross median at $1,161.84 an ounce. And they ended the day Friday at the closing bell, $1,141.77 an ounce. Now, if you go back 6, 7, 8, 9, 10, maybe 10 podcasts, I spoke on the fact that precious metals are the one verifiable way that can stand the test of time and can be held as an insurance in unsure times. Since the November 8 election, gold has been down 10%, but it's currently up 6% on the year, which began January the 1st, 2016, at $1,063.22 per ounce. After last year's quarter point hike, which is what they promised, but they made us wait again another 12 months for them to do a quarter point, maybe. A similar move south to find support in mid-December at $1,061.98 an ounce. We're talking about the price of gold. And then it rallied in February to $1,230.85 an ounce. In February. In a way, we're seeing a similar reaction by the market, but there are important differences that show investors are misled or misreading the implications of rising interest rates in Trump's, the POTUS, the president-elect's fiscal stimulus plan. I go back 2 podcasts. There can be no fiscal stimulus without monetary stimulus. If you're just going to start the printing presses again and create more paper, which is more quantitative easing, which I spoke on, you can look back, is going to lead us down a dark road that nobody really wants to go because you can't see the forest for the trees. Investor exuberance in stocks could be characterized as quote unquote irrational, given the drag interest rates are going to experience on any stimulated growth, meaning that it's not true, it's not real, it's fabricated. Just like Trump being elected and winning the electoral college or what have you, it's all confidential reaction to everyone. They're seeing the opportunities from Trump's promised proposed tax cuts and the deregulation. But if you look close at his proposed tax cuts, he's not going to tax the wealthy, which is one of which he claims to be. The stocks are already overpriced, and higher interest rates will tramp down and lower the consumer and the business spending, decreasing their value even further than it is now. The hope is that tax cuts will offset the rising price in borrowing costs. That is so irrational, but the side effects of national debt expansion will be much more significant this time. Think back, George Bush's 2001 Economic Growth and Tax Relief Reconciliation Act increased the national debt by $1.3 trillion over a 10-year period. This is according to the Balance. I'll send you the link to the newspaper. You can chart the progress and look at the charts for yourself and the numbers, which never lie. Period. End of paragraph. In the sentence, the U.S. simply has no room left to borrow more money. That being said, in the face of everything that's going on, the Fed has no more money to give out. It's going to be the IMF that turns around and is the perpetual lender at things. The Fed's monetary policy of providing easy money for so long will also have negative side effects for those with mortgages and auto loans. The mortgage slowdown in new applications is already underway. Higher interest rates mean higher monthly payments for homes and cars. The interest will also cut into the benefits of tax cuts. Lower demand in housing will ripple throughout the economy and serve as resistance to stimulus. Ladies and gentlemen, you guys can look at the charts that I'm attaching to the podcast tonight. I want to wish you a happy holidays, which is coming next week today. Next week, Sunday. Today is the 18th of December, 2016. Do the numbers for yourself. Do your own due diligence, and you will see that everything is coming in place, as I told you guys 12 months ago. I want to finish with a quote from one of my mentors. I'm a fledgling mentee of his, Peter Schiff. He explains, quote, "Look at the housing market. Look at the auto market. These big sectors have been made possible by cheap money, and you can't take it away without some serious losses being exposed," unquote. Despite its recent price decrease, gold continues to prove its value as an instrument of wealth retention. Wealth retention, ladies and gentlemen. You've got to hold on to what you had. If you had gold at the beginning of the year, you've not only insured your wealth against a market oversaturated with cash, you've increased it. Buying gold and silver is essential to diversifying any portfolio. Start 2017 knowing your hard-earned wealth is backed by real money. That being said, every cell phone that you see is replenished with silver. Every button has got silver in the buttons that you're pressing. You got these touch screens. The cell phone needs silver to be able to operate the way that they do. The screens need silver fillings behind the screens. Every computer that you use, every iPod, iPhone that you're using, your children are using, your wives are using, the TV flat screen that you're watching, silver fillings in the screen to give the straight ambiance that you're there with the actors that you see in the movies that you like. So that means, ladies and gentlemen, be a part of the winning team. Thank you for your time. Please rate, like, share, and subscribe to my podcast, The Fireside Chat with the Guru. Ciao. Happy holidays.